The GBP-USD pair is caught in a battle between two major forces, the US central bank and mounting political and economic worries in the UK. The US dollar's edge in the UK, recent inflation at 3.8% is very close to the Bank of England's 4% interest rate, but remains above the target of 2%. Any rate cut risks fueling a wave of price increases in the UK. In contrast, the Fed has recently cut their benchmark interest rates by 25 basis points. With US August inflation at 2.9%, also above its target of 2%, there is more room to soften its interest rates compared to the UK. In his most recent major speech on September 23rd, Fed Reserve Chair Powell emphasized that inflation risks persist, indicating that aggressive monetary policy easing is unlikely and interest rate decisions will depend on a meeting-to-meeting basis. With US 10-year yields holding above 4%, the dollar remains attractive compared to sterling. British pound political and economic risks. The British pound, meanwhile, is facing significant challenges from political and economic instability. Investor confidence is being tested by the government's ability to manage its finances. The bond auctions were a critical moment, as a lack of demand would signal that financial markets have lost faith in the government. The situation is made worse by the looming threat of more borrowing to fund new spending and possibility of more tax hikes in the UK. Critical events to evaluate are the recent UK bond auctions, including a £4.75 billion Treasury 2030 sale on September 24th and a £1.5 billion sale on 23rd, have raised red flags. The 2030 auction saw the weakest coverage ratio in 2 years, while 2056 auction, although oversubscribed, signaled investors demanding higher yields. Both outcomes underscoring growing concerns about gilt market stability. There are growing fears that November budget will throttle UK economic growth, as the budget plans to address a £62 billion deficit with tax hikes and spending cuts, risking further erosion of low consumer and business confidence amid inflation and slow growth. Political risks are also rising, with some investors nervous about a potential challenge to Prime Minister leadership after Andy Burnham revealed that Labour MPs are privately urging him to run for the top job. So coming to the GBP USD outlook, with Fed Chair Powell signaling that aggressive rate cuts are unlikely, the recent weakening of the US dollar may pause while the pound remains weighed down by fiscal and political headwinds. In this backdrop, pound exporters should maintain a healthy hedge ratio at the current GBP USD levels, given the currency's uptrend over the past few months, while pound importers may benefit from waiting for reasonable correction of 2 to 3% in the GBP USD pair to restart hedging. That's all for this video. Thank you for watching.